If you've been stacking silver back when it hovered between $20 and $30 an ounce, you're sitting on gains that most investors will never experience in their lifetime. What used to feel like a hedge, something tucked away for safety, has quietly transformed into a serious profit. And at some point, whether by plan or necessity, some of that profit is going to move. That's when a moment hits that catches a lot of people off guard. You walk into a coin shop, call a dealer, or set up a private sale, and suddenly realize something uncomfortable. You don't actually know what the IRS can see. Not clearly, not confidently. You've heard bits and pieces, maybe something about cash limits, maybe certain coins not being tracked, maybe wire transfers being invisible. You've seen forum posts, watched videos, picked up fragments of advice. But if someone asked you to explain exactly what triggers IRS reporting and what doesn't, you'd probably hesitate. That hesitation can cost you, and it cuts both ways. Some investors overpay. They assume every silver transaction is visible, report more than necessary, and lose money simply because they misunderstand the rules. Others go the opposite direction. They assume that if no paperwork shows up, there's nothing to report. That mistake can come back years later with penalties far worse than the original tax bill. Both sides are operating in the dark, and both are losing money because of it. The truth is simpler, but it requires one key shift in how you think. Reporting and taxation are not the same thing. They are two completely separate systems, built for different purposes. Until you separate them in your mind, everything else becomes confusing. Reporting answers. One question: what can the IRS already see? Taxation answers a different one. What are you legally required to report yourself? Certain transactions trigger forms that dealers must file. These forms create visibility. The two most relevant in the silver market are Form 1099-B and Form 8300. A 1099-B is filed when a dealer buys specific types and quantities of bullion that fall under reporting rules. Form 8300, on the other hand, is about cash. If a business receives more than $10,000 in cash or cash equivalents in a transaction, they must report it. These forms don't calculate your taxes. They don't determine what you owe. They simply tell the IRS that something happened. Your tax obligation comes from a different place entirely. It comes from capital gains law. Physical silver is considered a collectible, and when you sell it at a profit, that profit is taxable. If you've held it for more than a year, the gain can be taxed at rates up to 28%. If you sell sooner, it can be taxed as ordinary income, potentially higher depending on your bracket. Here's the critical point. A transaction can generate 0 reporting forms and still be fully taxable. No paperwork does not mean no obligation. The system expects you to report gains whether or not a dealer reports anything. Understanding that distinction changes everything. Start with the simplest scenario: holding silver. Owning silver does not trigger any IRS reporting. There's no registry of your holdings, no form you file annually just because you have metal in a safe or vault. You can hold any amount, large or small, without notifying any government agency. The system is transaction-based, not possession-based. Nothing happens from a reporting standpoint until the silver is sold, traded, or converted into something else. That alone clears up a major misconception. The government is not tracking your stack as it sits there. But the moment it becomes part of an economic transaction, the situation changes. Even then, not every sale triggers reporting. This is where many people get it wrong. Dealer reporting is conditional. It depends on the type of product and the quantity involved. The rules were designed around large institutional scale transactions, not typical retail activity. For example, reporting thresholds often center around products like 1,000-ounce silver bars or very large amounts of pre-1965 coins. These are not what most individual investors are buying or selling. The average person dealing in 1-ounce coins, 10-ounce bars, or even 100-ounce bars is usually operating below those thresholds. You could sell a sizable amount, say 100 ounces at current prices, and still not trigger a 1099-B. That's thousands of dollars changing hands with no automatic reporting form. But again, that doesn't remove the tax obligation. If you bought low and sold high, the gain is still taxable. There's also a product-specific nuance that many people talk about: American Silver Eagles. These coins are widely recognized and commonly treated by dealers as non-reportable under typical conditions. This isn't because there's an official IRS exemption. It's more about how the reporting framework was originally designed and how industry practices have evolved. In practice, many dealers don't file 1099-B forms when buying Silver Eagles from customers, even in large quantities. But relying on that as a tax advantage is a misunderstanding. It may affect whether a form is filed, but it does nothing to change the underlying tax rules. Profit is still profit, and it's still taxable. Then there's the second reporting system, which has nothing to do with the type of silver at all. Form 8300 is triggered by how a transaction is paid, not what is being sold. If a business receives more than $10,000 in cash, they must report it. The keyword here is cash, and the IRS definition is narrower than most people think. It includes physical currency and certain instruments like money orders or cashier's checks, but it does not include personal checks, bank wires, or electronic transfers. This creates situations where two identical transactions can have completely different reporting outcomes. One person receives cash and triggers a report. Another receives a wire transfer and does not. Same amount, same deal, different visibility. However, there's an important rule about related transactions. If payments are split into smaller amounts that are clearly connected, they can be combined for reporting purposes. This is where people run into serious trouble. Deliberately breaking up a transaction to avoid reporting is called structuring, and it's a federal offense. It doesn't matter whether taxes are owed or not. The act itself, intentionally dividing payments to stay under a threshold, is what creates the problem. Penalties for structuring can be severe, including large fines and even prison time. Dealers are trained to watch for this behavior, and they are required to report suspicious patterns. What might seem like a clever workaround can quickly turn into a legal issue. On the other hand, selling portions of your silver over time for legitimate reasons is completely normal. The difference comes down to intent. If you're simply managing your assets, you're fine. If you're deliberately manipulating transactions to avoid reporting, that's when the line is crossed. Private sales add another layer. When you sell directly to another individual, there's no dealer involved, which means no automatic reporting forms like 1099-B or 8300. From a visibility standpoint, these transactions often fly under the radar of dealer-based reporting systems. But again, the tax obligation remains. A private sale doesn't erase the gain. And while there may be no immediate reporting form, financial records can still exist through bank transfers or other means. If questions ever arise, those records can be examined. A lot of confusion in the silver community comes from persistent myths. One of the biggest is that reporting thresholds have been lowered to $600 or $3,000. This is not true for precious metals. Those numbers come from entirely different areas of financial regulation and do not apply to bullion dealer reporting. Another myth is that pre-1965 coins are tax-free because they're legal tender. That's not how the tax code works. The IRS looks at market value, not face value. If you profit from selling those coins, the gain is taxable, regardless of their original use as currency. The most dangerous myth is the idea that no form means no tax. That misunderstanding leads people into serious trouble. The tax system relies on self-reporting. The absence of a form does not remove your responsibility to report gains. All of this leads to one critical practice: documentation. Your cost basis, the amount you paid for your silver, determines how much of your sale is considered profit. Without records, proving that cost basis becomes difficult or impossible. If you can't prove what you paid, the IRS may assume your cost basis is zero. That means the entire sale amount could be treated as taxable gain. Suddenly, you're paying tax not just on profit, but on your original investment as well. Keeping records protects you from that outcome. Every purchase receipt, every invoice, every detail matters. Premiums, shipping costs, and other expenses can all be part of your cost basis. The more accurate your records, the more precise your tax calculation will be. There are also special situations to consider. Inherited silver often receives a stepped-up basis, meaning its value is reset to market value at the time of inheritance. This can significantly reduce taxable gains. Gifted silver works differently, usually carrying over the original owner's cost basis, which can lead to larger gains when sold. Without proper documentation, these distinctions can't be applied correctly. At the end of the day, the system isn't as mysterious as it seems. It just requires clarity. Holding silver doesn't trigger reporting. Selling it might, depending on the details. But taxation is always based on the gain, not on whether a form was filed. The investors who navigate this successfully aren't the ones trying to stay invisible. They're the ones who understand the rules, keep solid records, and make informed decisions. They don't overpay out of fear, and they don't underreport out of misunderstanding. Because when the time comes to sell, clarity isn't just helpful, it's profitable.